What causes asset bubbles? Have you ever wondered why some markets seem to explode with value overnight, only to crash just as quickly? This phenomenon is known as an asset bubble. So, what really causes these bubbles to form? Asset bubbles occur when the prices of assets, like stocks, bonds, or real estate, rise rapidly and excessively beyond their true worth. This situation often arises from an imbalance between supply and demand, usually fueled by an increase in money and credit within the economy. One major factor is excessive monetary policy. When central banks, like the Federal Reserve, adopt overly accommodating policies, they can increase the money supply. This means more money is available to just fewer assets, driving prices up beyond their actual value. Market psychology plays a significant role too. Human emotions such as greed and fear can lead to herd behavior among investors. People may buy assets not because they believe in their fundamental value, but simply because they see others doing the same. This can create a feedback loop that pushes prices even higher. Technological advancements and favorable policies can also contribute to asset bubbles. When new technologies emerge or when government policies incentivize investment in certain sectors, it can lead to rapid price increases. Another aspect to consider is the regulatory environment. Weak regulations can allow for excessive risk-taking and leveraging, which can further fuel the formation of bubbles. Historically, specific economic conditions and events have influenced which assets become the focus of a bubble. For instance, the technology sector saw a significant bubble in the late 1990s, while real estate experienced a similar situation in the mid-2000s. From a conservative viewpoint, asset bubbles are often seen as a result of government intervention in the economy, particularly through monetary policy. Many conservatives argue that central banks should avoid overly expansive policies to prevent bubbles from forming. They often advocate for stronger regulations to limit excessive risk-taking and ensure that financial institutions remain resilient during economic downturns. In the context of free market economics and fiscal policy analysis, asset bubbles highlight the challenge of balancing economic growth with financial stability. Conservatives typically emphasize limited government intervention and a hands-off approach to economic management. However, the reality is that asset bubbles can have severe economic consequences. This situation necessitates some form of regulatory oversight to mitigate their impact. Understanding the causes of asset bubbles can help us navigate the complexities of our financial systems. By recognizing the interplay between monetary policy, market psychology, and regulatory frameworks, we can better prepare for the potential risks associated with these economic phenomena.